A financial transaction is an agreement, or communication, between a buyer and seller to exchange goods, services, or assets for payment. Any transaction involves a change in the status of the finances of two or more businesses or individuals. A financial transaction always involves one or more financial asset, most commonly money or another valuable item such as gold or silver. There are many types of financial transactions. The most common type, purchases, occur when a good, service, or other commodity is sold to a consumer in exchange for money. Most purchases are made with cash payments, including physical currency, debit cards, or checks. The other main form of payment is credit, which gives immediate access to funds in exchange for repayment at a later date. There is no evidence to support the theory that ancient civilizations worked on systems of barter. Instead, most historians believe that ancient cultures worked on principles of gift economy and debt. 5. In a gift economy, valuables are given without any formal declaration of repayment, often thought to be a form of reciprocal altruism. Official systems of credit and debt were first created around 1800 BCE by the Babylonians, who established the first formal interest rate limits with the Code of Hammurabi. Many cultures around the world began using commodity money objects whose value comes from their intrinsic value. These often included gold or silver coins, along with non-metal objects such as cowrie shells, beaver pelts, and dried corn. Between 1000 BCE and the first millennium CE, coinage became increasingly common throughout Europe and Asia. In England, banknotes were introduced starting in the 17th century. Each note promised to pay the bearer the value in gold upon demand. This is called a gold standard. In the 20th century, many countries gradually phased out the gold standard in favor of fiat money that is not backed by any commodity. Since the start of the 21st century, online banking has become much more widespread. By 2001, tens of millions of people were doing their banking on the internet. By 2012, between 46 and 82% of all transactions were done electronically. 15 digital currencies, currency that is stored on electronic systems, have gained popularity. Bitcoin, invented in 2009, reached a cap of over $1 trillion in 2021. One of the downsides of cryptocurrencies is that since they are not tethered to any tangible assets, their price can fluctuate wildly, sometimes by 20% or more in a single day. Types of transactions. Cash transactions. A cash transaction is any transaction where money is exchanged for a good, service, or other commodity. Cash transactions can refer to items bought with physical money, such as coins or cash, or with a debit card. These differ from credit transactions because the money is immediately taken from the buyer and given to the seller. Credit transactions. Transactions that use credit involve a deferred payment for the goods or services rendered. When something is bought using credit, it gives the seller an asset, the payment at a later date, and gives the buyer a liability, the amount that must be paid at a later date. Credit cards are an example of when credit is used, where the card issuer, usually a bank, gives the customer a line of credit with which they can make purchases. The liabilities the customer accrues with the card are usually paid off at a set date, and any unpaid liabilities create interest for the issuer. Loans and mortgages are examples of credit. The lender agrees to give out a lump sum, the principal, to the borrower, who pays back the loaned amount over a set period of time, called a term. The lender usually charges an additional percentage on top of the initial amount borrowed, called the interest rate. Mortgages are similar to loans, but are usually for a larger amount of money and over a longer term, often for buying real estate. Mortgages are almost always secured by collateral, most commonly the real estate they are being used to purchase. If the borrower fails to make the necessary payments on the mortgage, the lender has the right to claim and sell the property in a process known as foreclosure. Internal and external transactions. External transactions are any business transactions that involve more than one party. For example, A company buying inventory from a supplier would be considered external. All cash and credit transactions are external, since they affect the finances of more than one person or group. On the other hand, internal transactions only affect one business. Shifting goods between different departments in a business is an internal transaction, since it does not change the overall finances of the company. A financial transaction is the exchange of money between two or more parties, shaping everything from your daily coffee run to international business deals. Understanding how these transactions work can help you manage finances better. Avoid unnecessary fees. Choose safer payment methods. In this guide, we'll simplify transaction types, uncover hidden security details, and explore the fascinating future trends. Let's dive in. What is a financial transaction? What happens when you buy a coffee, pay your rent, or send money to a friend? Each of these everyday actions is an example of a financial transaction. Simply put, a financial transaction is an exchange of money between two or more parties. It might sound technical, but you do it effortlessly every day. However, not everything you do at your bank qualifies as a financial transaction. Checking your balance or updating your phone number is an example of a non-financial transaction. Why? Because no actual money changes hands. On the other hand, actions like online shopping, transferring cash, paying utility bills, all activities that directly affect your account balance are all financial transactions. Types of financial transactions. Financial transactions come in various forms. Understanding each clearly can streamline your financial activities. An easy-to-follow breakdown of the most common types. Cash transactions. These involve direct payments using physical money, notes and coins. Cash transactions are immediate and anonymous, making them handy for quick, small purchases. However, they also carry risks like loss, theft, or the inconvenience of carrying large sums. Card payments. These transactions use credit or debit cards issued by banks and financial institutions like Visa or MasterCard. Card payments are perfect for shopping online or in-store, providing a secure, traceable method. Each transaction involves an authorization process where your bank confirms you have sufficient funds, adding an extra layer of security. Bank transfers. Electronic transfers like ACH or wire transfers involve directly moving money from one bank account to another. They're widely used for payroll, bill payments, or large financial transactions. While bank transfers are safe and reliable, they often take longer, ranging from a few hours to a few days to complete, depending on the banks involved. Mobile payments. Transactions made via digital wallets or apps like Google Pay, Apple Pay, or SataPay. These offer unmatched convenience. Just tap your smartphone, and your payment is complete in seconds. Digital wallets typically provide extra security measures such as biometric verification, encrypted payment details, and real-time transaction notifications. Cryptocurrency transactions. These digital transactions use decentralized currencies like Bitcoin, Ethereum, and others built on blockchain technology. Crypto transactions are praised for their speed, privacy, and minimal transaction fees. However, their value can fluctuate significantly. That makes them suitable for users comfortable with financial risk and volatility. How financial transactions work. Every financial transaction, tapping your card or sending money online, follows a transparent, systematic process. Let's break it down step by step. 1. Initiation. You start the transaction by agreeing to exchange funds for goods, services, or transferring money. For example, you purchase shoes online and enter your card details. 2. Authorization. Your bank or payment service provider verifies your information and checks if you have sufficient funds. This usually takes mere seconds, ensuring secure and quick validation. 3. Clearing. Banks and payment networks, like Visa or MasterCard, exchange details to ensure everything matches up. This step confirms the exact amount and ensures both parties are legitimate. 4. Settlement. The final step, where money officially moves from your account to the recipient's account. The transaction is now complete and reflected in your account statement shortly after. Financial transaction systems and security. With digital payments growing rapidly, secure and reliable systems are critical for smooth financial transactions. Let's explore key financial transaction systems examples and how they protect your money. SWIFT. A secure global network trusted worldwide for international bank transfers. It connects banks globally, making cross-border transactions safe and seamless. ACH, Automated Clearinghouse. Widely used for domestic bank transfers, including salaries, recurring bills, and payments. It's fast, cost-effective, and efficient for everyday transactions within the country. Blockchain payments. Utilizing blockchain technology, these transactions such as Bitcoin offer unmatched transparency and security. Blockchain records every transaction publicly, ensuring no data tampering or fraud. Digital wallets. Apps like Google Pay and Apple Pay provide instant transactions with robust security measures. These digital wallets use biometric verification, fingerprints, Face ID, to secure your payments. Advanced security measures. Security protocols like encryption, two-factor authentication, 2FA, and AI-powered fraud detection add extra layers of protection. These technologies detect suspicious activity in real time, keeping your financial information safe. A financial transaction involves a change in the value of assets, liabilities, or owner's equity in a business. An example is buying a new car, acquiring a new house, or purchasing airline tickets. What is the difference between a financial and non-financial transaction? Financial transactions involve the transfer of money or items of value. In contrast, non-financial transactions do not involve any exchange of funds or financial assets. What are the types of financial transaction? There are 4 primary types of financial transactions. They are: 1. Sales. These transactions involve the legal transfer of property. 2. Purchases. Businesses require purchases to obtain the goods or services needed to accomplish organizational goals. 3. Receipts. These are written acknowledgments that confirm one party has received a defined amount of goods or money. 4. Payments. Occur when a business pays another business for goods or services received. Business involves the buying and selling of goods or services. In other words, business is about transactions. But what is a transaction? When two parties complete an agreement to exchange an item, service, or financial asset for money, they have engaged in a transaction. Since this transaction definition entails a monetary exchange for a product or service, it is important to introduce the concept of a financial transaction. A financial transaction involves an activity that changes the value of the assets, liabilities, or owner's equity in a business. Almost everyone is involved in a financial transaction at some point or another. Examples of typical financial transactions include purchases at the candy store, buying a new house, paying monthly bills. For a financial transaction to work, there must be 2 willing parties, a seller and a buyer. The transaction must involve money in one way or another. Activities that change the value of liabilities, assets, and owner's equity are important in accounting. Financial transactions are chronologically documented in accounting journals. Any transaction that impacts monetary value and account balances is a financial transaction. They are recorded in accounting journals. Such events are important to investors, managers, businesses, and consumers. So what are the different types of financial transactions that these stakeholders record or engage in? There are 4 primary types of financial transactions in the business world. They include sales, purchases, receipts, payments. Sales are financial transactions that involve the legal transfer of property in return for money or credit. Businesses earn revenue from the sale of goods and services. The primary source of this revenue is customers who purchase the items. Sometimes, the sale is made in exchange for credit rather than cash. In this case, the financial transaction is documented as account receivables. The transaction is recorded as a debit by the seller where money is involved. An example of a sale is when a grocery store sells vegetables to a customer. Financial transactions are part of everyday business activities. The following real-life accounting transaction examples provide more insight into the nature and importance of financial transactions. What is a transaction in accounting? As already stated, transactions involve the exchange of goods, services, or financial assets. In most cases, these transactions involve the exchange of money. As such, transaction records detail the specific amount of cash received or paid, the property exchanged, and the date. Recording these transactions is important as it helps businesses keep track of their expenses and incomes. Accounting also facilitates compliance with financial transaction tax policies. The typical methods for recording transactions are accrual accounting, cash accounting. Transactions involve a completed agreement between two parties for the exchange of goods, services, or financial assets. When these transactions involve activities that change the value of the assets, liabilities, or owner's equity in a business, they are called financial transactions. Any activity that does not involve the transfer of money, goods, or services is called a non-financial transaction. Sales is a financial transaction where a property is legally transferred in return for money or credit. Businesses require purchases to obtain the goods or services needed to accomplish their organizational goals. Another type of financial transaction is receipts, which are written acknowledgments confirming a business has received a specific amount of goods or cash. Lastly, payments are transactions that occur when a company pays another business for goods or services received. Financial transactions where cash payments are expected in the future are recorded in accrual accounting. On the other hand, cash accounting records transactions only when revenues and expenses have been received. Think about your activities of the last week. How many of those involved making a purchase? It could be that the purchase was as small as a piece of gum from a candy store or as large as a new house. Did you pay any monthly bills that were due last week, like a car payment or utility bill? If you did any of those things, then you were part of a financial transaction. What exactly is a financial transaction? In the accounting industry, a financial transaction is one in which there is some sort of activity that changes the value of the assets, liabilities, or owner's equity of an organization. These types of transactions are two-part transactions consisting of a buyer and a seller, and they always involve money in some way. Financial transactions in accounting are recorded in the accounting journal in chronological order. Types of financial transactions. There are four main types of financial transactions that occur in a business. These four types of financial transactions are sales, purchases, receipts, and payments. Let's take a minute to learn about each one. Sales are the transactions in which property is transferred from buyer to seller for money or credit. Sales transactions are recorded in the accounting journal for the seller as a debit to cash or accounts receivable and a credit to the sales account. Purchases are the transactions that are required by a business in order to obtain the goods or services needed to accomplish the goals of the organization. Purchases made in cash result in a debit to the inventory account and a credit to cash. If the purchase is made with a credit account, the debit entry would still be to the inventory account and the credit entry would be to the accounts payable account. Receipts refer to a written acknowledgement of having received or taken into one's possession a specified amount of goods or money. Payments are the transactions that refer to a business receiving money for a good or service. They are recorded in the accounting journal of the business issuing the payment as a credit to cash and a debit to accounts payable. Thank you for watching this video.